The central idea is that we may not be heading into a typical recession, but into a deeper structural shift in how the global monetary system works. A normal recession happens inside a stable framework. Economic activity slows, companies reduce hiring, central banks lower interest rates, and over time, growth returns. The overall system stays the same, and recovery follows a familiar pattern. The argument here is that today's environment does not fully match that script. Several recent developments suggest that the foundation of the system itself may be under pressure. In the past few years, governments and central banks have used unusually large stimulus measures, expanded public debt, and kept financial conditions loose for long periods. At the same time, inflation rose sharply and interest rates increased to levels not seen for many years. Even with higher rates, debt levels remain elevated, and geopolitical tensions have influenced trade, energy markets, and financial flows. These factors combined raise questions about how sustainable the current model is over the long term. For decades, many retirement strategies and investment approaches have been built on assumptions such as moderate inflation, gradually declining interest rates, and strong global demand for dollar-based assets. Broad index investing and bond-heavy portfolios made sense in that environment. If the global system moves toward a different balance, with more persistent inflation, higher borrowing costs, or a more multipolar financial structure, those assumptions may not work in the same way. The key message is not panic, but awareness. Investors may need to understand that the economic game they prepared for in the past could look different in the years ahead. Building on that idea, one of the biggest pressures on this system comes from the scale of government debt and the policies used to manage it. The concern is not only that the debt is large, but that the structure around it may be harder to sustain over time. When a country carries debt close to or above the size of its entire economy, the cost of paying interest becomes a central issue. As rates rise, more public money goes towards servicing past borrowing instead of future investment. In recent years, central banks have played a major role in stabilizing government bond markets. By purchasing large amounts of bonds, they help keep borrowing costs from rising too quickly. This can support financial stability in the short term, but it also increases the money supply and can add to inflation pressures. Over time, frequent reliance on this approach may lead investors to question how long it can continue without side effects. Trust in a reserve currency depends heavily on confidence that its value will be preserved, not only today, but in the future. This situation also looks different from earlier periods of high debt. Decades ago, stronger demographic growth, expanding industry, and different global conditions supported faster economic expansion. Today, slower population growth, global competition, and ongoing budget deficits make the path more complex. Because the dollar-based system relies more on confidence than on a fixed physical backing, political disagreements and repeated emergency measures can influence how global investors view long-term risk. If that confidence weakens, lenders may demand higher returns, which feeds back into higher costs for the entire system. As these financial pressures build, the discussion also shifts from pure economics to social and political dynamics. Another layer of risk comes from rising inequality and the strain it can place on stability. When wealth and opportunity become concentrated in a small segment of society, more people may feel left out of economic progress. Over time, that frustration can show up in stronger political divisions, more heated public debate, and greater difficulty reaching long-term policy agreements. From a market perspective, this is not only a social story, it can influence how investors judge risk. Long-term government bonds are built on confidence that a country will remain stable, meet its obligations, and manage its finances in a predictable way. If politics becomes more polarized and policy direction swings more sharply from one period to another, investors may start to question that predictability. Even the perception of instability can be enough to change behavior, especially for large institutions and foreign reserve managers who think in decades, not months. In that environment, some central banks and institutions choose to diversify part of their reserves into assets that are not directly tied to any single government. Gold is often mentioned in this context because it has historically been used as a store of value across different systems. The idea is not about nostalgia, but about balance. By holding a mix of currencies and tangible assets, countries aim to reduce exposure to any one political or monetary framework. This gradual diversification reflects a broader theme that trust, stability, and social cohesion are closely connected to financial confidence in the modern global system. These internal and financial tensions are unfolding at the same time as major shifts in global politics. International conflict and the use of financial sanctions have added another layer to how countries think about money and reserves. When access to payment networks, foreign exchange reserves, or cross-border transactions can be restricted for political reasons, it highlights how closely finance and geopolitics are now connected. Actions taken during recent conflicts showed how powerful the existing system can be, but they also changed incentives. Countries that are not directly involved in any dispute may still look at these events and ask how exposed they are. As a result, some governments and companies have shown interest in settling more trade in local currencies or in a mix of currencies, rather than relying on a single one for everything. These moves do not necessarily replace the current system overnight, but they can slowly reduce the automatic demand that once flowed into certain government bonds and financial markets. If global investors and central banks diversify even part of their reserves, the effects can build over time. Lower structural demand for one country's debt means that, in the future, it may need to offer higher returns to attract buyers. Higher interest costs then feed back into public finances and economic conditions. This process can resemble a confidence shift more than a sudden crisis. Once alternatives exist, even if they are imperfect, more participants may use them as a precaution. Step by step, collective decisions can reshape the balance of the global financial system without a single dramatic turning point. All of these global and domestic shifts eventually reach the level of individual households, especially when it comes to long-term savings. Many retirement plans are built on projections that assume a fairly stable environment. Financial models often use average stock returns around historical norms, moderate inflation, and the idea that the purchasing power of money will not change too dramatically over time. For years, this framework worked reasonably well, which is why it became so widely accepted. But if inflation remains higher than in the past, even by a few percentage points, the long-term effect can be significant. A portfolio might grow in dollar terms, and statements may show larger balances each year. Yet, those dollars could buy fewer goods and services in the future. Over decades, the difference between moderate and higher inflation can mean a large gap in real lifestyle. This is especially important for people who are not actively adjusting their savings rates or investment mix. At the same time, interest rates influence both bonds and stocks. When rates are elevated, bond prices tend to fall, and the present value of future corporate earnings is discounted more heavily, which can weigh on stock valuations. Many target date funds gradually shift toward bonds as investors get older, aiming for stability. In a world of persistent inflation and higher rates, that shift may not provide the same protection people expect. The risk described here is gradual, not dramatic. It is a slow mismatch between old assumptions and new conditions, where numbers on a screen rise, but real financial security does not increase at the same pace. When we connect everything discussed so far, the main takeaway is not about panic or extreme predictions, but about thoughtful preparation. Economic systems evolve, and periods of change can last for many years. Instead of assuming the future will look exactly like the past, it can be helpful to build flexibility into long-term plans. This starts with diversification, not only across different companies or sectors, but across asset types and regions. A mix that includes financial assets, some exposure to real assets, and a global perspective can help reduce dependence on any single outcome. Another lesson involves understanding interest rate and inflation risk. Long-term bonds and traditional portfolio structures were designed for a world of falling rates and stable prices. If conditions differ, investors may benefit from paying closer attention to duration, liquidity, and how their assets react under different economic scenarios. Having some flexibility allows adjustments over time rather than being locked into one structure. Just as important is the human side. Skills, education, adaptability, and the ability to create value through work or enterprise remain powerful forms of security. Financial markets matter, but personal capability travels across different systems. The broader psychological message is that success often comes from recognizing when the environment shifts and responding calmly, not from chasing every short-term move. For viewers, the practical advice is to stay informed, review assumptions behind long-term plans, and focus on balance and resilience. Change does not happen overnight, but small adjustments made early can have a large impact over decades. Awareness, flexibility, and steady learning can be just as valuable as any specific investment choice.